There's a belief right now among a lot of people that you can't buy a good investment property for under $750,000 anymore. And I understand where it comes from. If you're looking at the major capital cities, the numbers don't work the way they used to. But I think a lot of people are drawing the wrong conclusion from that. They're looking at what $750,000 buys in the cities they know, and they're assuming that's the whole picture. It's not. Australia is a big country, and when you actually run the data at a national level, there are suburbs in almost every state where $750,000 still gets you a structurally sound investment with strong fundamentals. You just have to know what to filter for. I found 5 of them, all across Australia. So let me show you where they are and why they made the cut. But before I get into the suburbs, I want to quickly walk you through how I found them. Because at the sub $750,000 price point, the margin for error is smaller. You're not buying into established blue chip suburbs with decades of proven growth behind them. That's why the framework matters. When I look for a good investment suburb, I want vacancy rates below the national average, which right now is about 1.5%. I want a gross rental yield of at least 4%. I want low stock on market. I want owner-occupier dominant demographics, low public housing concentration, forecasted population growth above 1% per year, and diverse industry composition across stable sectors like healthcare, education, and government. And the reason for this is that these are the metrics that tell you whether demand in a suburb is real and sustainable, or whether it's being propped up by short-term conditions that can shift. At this price point, you can't afford to get that wrong. When I applied this across every state at the sub $750,000 price point, these are the 5 that came through. Let's start with the first one. The first one sits in far north Queensland, about 15 minutes south of the Cairns CBD, a suburb called Mount Sheridan. The median house price is $690,000. It's grown 13.58% over the last 12 months, and over 5 years, the annual capital growth rate is 11.8%. The vacancy rate is 1.39%, days on market is sitting at 11, and the gross rental yield is 4.9%. There are currently 13 properties listed for sale, with a stock on market percentage of 0.39%. So what is this telling us about Mount Sheridan? When properties are moving in 11 days and only 0.39% of the suburb's housing stock is available for sale, you're looking at a market where demand is genuinely outpacing supply. Now, the yield at 4.9% is still solid, but it has started to compress over the last 12 to 18 months. And that's actually what you'd expect to see in a growing market. When capital growth starts to outpace rental growth, yields come down. It's a sign that prices are moving. The fact that the yield is still sitting close to 5% even after that compression tells you the rental side is strong. You're still getting meaningful cash flow alongside that growth, which at this price point is a combination worth paying attention to. The Cairns region also has a significant infrastructure pipeline supporting it. There's a $250 million hospital expansion underway, a $225 million Bruce Highway upgrade that's been approved, and a water security project valued between $251 and $500 million. That level of government investment into a regional area tells you there's a long-term commitment to this region's growth, and that flows directly into jobs, population, and housing demand. The demographic profile supports it as well, 72% owner-occupiers, and that number has been climbing every census period since 2006. The top industries are hospitals, takeaway food services, and social assistance. So you've got that healthcare and essential services base rather than reliance on a single volatile sector. The public housing concentration is 2.15%, which is still classified as negligible. Now, there is one thing I want to flag. On the house side, development approvals have been relatively stable and manageable across the Cairns local government area. But on the unit side, approvals spiked to 276 in 2025, up from just 30 the year before. So if you're looking specifically at units in this area, that's the incoming supply you'd want to factor in. On the house side, I'm comfortable with where the data sits. The second suburb is in Victoria, and this one might raise a few eyebrows, because when you look at the headline numbers, they're not as clean as Mount Sheridan. Leopold sits about 61 kilometres from the Melbourne CBD within the greater Geelong area. The median house price is $700,000. The 12-month growth is 6.87%, and the 5-year annual capital growth rate is 5.41%. Vacancy is sitting at 0.79%, which is actually the tightest of any suburb I'm covering today. Days on market is 34. The gross gross rental yield is 3.9%, and there are currently 90 listings with a stock on market percentage of 1.67%. Now, if you look at the 3-year growth, it's actually slightly negative at minus 1.27%. So you might be wondering why this suburb made it to the list at all. And I get it. When you see negative growth over a 3-year period, the natural reaction is to move on. But here's where a lot of investors make a mistake with the data. They treat the past as a prediction of the future, when what they should be doing is looking at leading indicators to see where the market is actually heading. And in Leopold, the leading indicators are telling a very different story to the trailing ones. The 12-month growth at 6.87% tells you that prices are starting to move again after a period of stagnation. Buyer demand is up 14.79% over the last 12 months, and listings have dropped over 20% in the same period. When you've got rising demand and falling supply at the same time, that's typically the setup for the next growth phase. And with the vacancy rate at 0.79%, the rental market is already under pressure. The Greater Geelong area also has 13 major infrastructure projects in the pipeline. That includes Barwon Women's and Children's Hospital, which is valued between 251 and 500 million and currently underway, and the Geelong Convention and Exhibition Centre at a similar value. The population has grown from around 8,700 in 2006 to over 13,000 in 2021, and the top industries are hospitals, social assistance services, and supermarkets. That's the kind of essential services employment base that holds up during a downturn. So Leopold isn't the suburb on the list with the flashiest numbers, but what I'm seeing in the data is a market that's been through a correction, found its floor, and is now showing early signs of recovery. And at $700,000 within a major growth corridor that's backed by serious infrastructure investment, I think it's worth paying attention to. The third suburb is also in Victoria, and it brings the price point down even further. East Bendigo, about 132 kilometers from the Melbourne CBD. Now, I want to be upfront about this one before I get into what I like about it. The renter percentage in East Bendigo is 39%, which is the highest of any suburb I'm covering today. The public housing concentration is just under 4%, and buyer demand has actually dipped slightly over the last 12 months. So this isn't a suburb where every metric is flashing green, and I think it's important to show you that, because not every suburb that passes the framework is going to be a clean sweep. The question is whether the strengths are strong enough to outweigh those risks. So let's look at the data. The median house price is $580,000, and units are sitting at $435,000. Houses have grown 8.92% over the last 12 months, with a 5-year annual capital growth rate of 9.71%. The unit yield is 5.14%, and house yield is 4.44%. Days on market is 21 for houses and 27 for units. There are currently 6 listings in the entire suburb with a stock on market percentage of 0.54%. So what stands out here is the supply. 6 listings in a suburb of over 1,100 dwellings, that number has dropped 50% in the last 12 months alone. And on the unit side, development approvals have been declining, which means there's no new stock in the pipeline to relieve that pressure. When you combine that tight supply with a yield above 5% on units, the rental market is doing a lot of the heavy lifting in this suburb. The Greater Bendigo area has 3 major projects in the pipeline, including the Melbourne to Mildura rail upgrade and the battery energy storage infrastructure. The top industries are hospitals, supermarkets, and social assistance, which gives you that essential services base. The population has been growing steadily, and the median weekly household income has climbed from $870 in 2006 to just over $1,250 in 2021. So the way I'd summarize East Bendigo is this. The demand side has some softness that you need to be aware of, but the supply side is genuinely tight. The yield is strong, and the price point at $580,000 for houses or $435,000 for units makes this one of the most accessible options on the list. If the demand indicators stabilize or start to turn, this suburb has some real potential, but it's one where you'd want to verify the conditions on the ground before committing. The 4th suburb is in Tasmania, and I know that's going to lose a few people straight away. When most investors think about property investment, Tasmania isn't the first state that comes to mind. But this is exactly the kind of market that goes overlooked because of the perception rather than the data. Parkland is a suburb in the Burnie area, about 236 kilometers from Hobart. The population is 865 people, so this is a very different scale to the other suburbs I've covered so far. The The median house price is $575,000. It's grown 13.86% over the last 12 months, and the 10-year annual capital growth rate is 9%. Units are sitting at $440,000, up 18.28% over the last 12 months, and 44.26% over 3 years. The vacancy rate is 0.61%, which is the tightest of all 5 suburbs I'm covering today. There are 5 listings with a stock on market percentage of 1.11%, and the gross rental yield on houses is 4.16%. Now let me address the obvious concern. This is a suburb with 865 people. In a market this small, things work differently. Days on market is sitting at 44, which is the longest of any suburb on this list. Buyer demand has declined 7.38% over the last 12 months. And if you needed to sell in a hurry, the pool of buyers is naturally smaller. So liquidity is a real consideration here. So why is this on the list? 2 things. First, the vacancy rate of 0.61% tells you that rental demand is genuine and persistent. In a suburb this small, that figure is significant. It means there are consistently more people wanting to rent here than there are properties available. And that underpins your rental income, regardless of what the sales market is doing. Second, and this is a bigger story, there is a $1.5 to $2.5 billion hydrogen e-fuels project currently underway in the Burnie area, along with a Savage River mine expansion valued between $251 and $500 million. There's also a $50 million Bass Highway upgrade in progress. That's billions of dollars in industrial and infrastructure investment flowing into a region with a very small housing stock. The demographic is also worth noting. 28% of residents are professionals, which is actually the highest professional concentration of any suburb on this list. The top industries are hospitals, social assistance, and secondary education. So Parklands isn't for every investor. If you need liquidity and a quick exit strategy, a market this size can work against you. But for someone who's comfortable with a longer hold and wants to get ahead of a major infrastructure cycle at a $575,000 entry point, the data here is hard to dismiss. The vacancy is the tightest I've seen. The rental demand is real, and the level of investment coming into this region relative to the size of the housing market is substantial. The 5th and final suburb is the one that surprised me the most when it came through the framework. It's in a state that most investors have completely written off, and I'll be honest, when I first saw the numbers, I had to double check them. Zuckerley is in the Northern Territory, about 24 kilometers from the Darwin CBD. Now, most investors don't even consider the Northern Territory. It doesn't make the lists. It doesn't get the YouTube coverage, and most buyers agents aren't operating there. But when I ran the data, Zuckerley came through and the numbers speak for themselves. The median house price is $650,000. It's grown 15.04% over the last 12 months, and over 3 years, it's up 151.94%. The 5-year annual capital growth rate is 27.69%, the highest of any suburb I'm covering in this video by a significant margin. The gross rental yield on houses is 6%, and on units is 7.1%. That's strong capital growth and strong cash flow in the same suburb at the same time, which is a combination you rarely see. The vacancy rate is 1.39%. There are 8 listings with a stock on market percentage of 0.56%, and the median rent on houses is $750 per week. So what does that tell us? At $650,000, you're getting a yield that most investors can only find in regional mining towns. Except this isn't a mining town. The top industries in Zuckerley are state government administration, defense, and hospitals. These are government-backed, stable employment sectors that don't disappear during a downturn. And the median weekly household income is just under $3,000, which is the highest of all 5 suburbs I've covered today. People living here earn well above the national average, and that supports both property prices and rental returns. Now, I need to be clear about something. Zuckerley is a new suburb. The population went from around 1,100 in 2016 to over 4,100 in 2021. That kind of rapid growth can be a strength or a risk depending on what's driving it. If the growth is being driven by genuine demand from stable employment, that's a positive signal. If it's being driven by speculative buying or developer-led oversupply, that's a very different story. So I looked at what's actually underpinning this suburb. 74% owner-occupiers. Public housing concentration at 0.77%, which is negligible. The employment base is anchored by government and defence. House development approvals in the Palmerston local government area have been increasing steadily, but not at a level that's been flooding the market. And the first unit approvals only came through in 2025 at just 27, so there's minimal new supply in the pipeline relative to the demand that's already there. The thing that most investors miss about the Northern Territory is the income profile. People work in government, defense, and healthcare in Darwin tend to earn significantly above the national average. That means that they can afford to pay higher rents and support higher property values. And because most investors overlook the Northern Territory entirely, there's less competition for quality stock. You're not up against 15 other buyers at every open home the way you would be in Sydney or Brisbane. At $650,000 with a 6% rental yield, 15% annual growth, and a demographic backed by government employment, Zuckerley is the suburb on this list that I think most people would never have found on their own. And that's exactly why it made the cut. If you're working with a budget under $750,000 and you're trying to figure out where the real opportunities are, I'm happy to have that conversation. I do a free strategy session where we look at your goals, your numbers, and where the data actually supports what you're trying to achieve. The link is in the description, and if this changed how you think about investing at this price point, then subscribe. I put out deep dives like this regularly. Thanks again for watching. Catch you in the next video.